How's it going today? Looks like a bullish day. Let's see what went up the most today. Urgently, it's a 9 million market cap company. That's a pretty small company. Urgently, I thought that was a bigger company. Maybe I'm thinking of something else. $9 million market cap. Really small. Let's see if any bigger stocks move today. Big Bear AI, 21%. Urgently, 64%. It's a lot for one day. Coursera. So these online educational companies seem to do well today. Liberty Broadband, Core Scientific, Tesla, 10%. A rough year, Tesla. Might be a good time to pick it up. It's 285 today. Damn, it was getting close to 500 just in December. Why did it go up so much today? Are they still talking about? Yeah, I released one of my portfolios. Actually, I shouldn't have done. I'm supposed to do it every 10,000 subs. I'm still upset. Like, no matter how much money you make, you still regret things. Like, I regret selling what's it called? Palantir. What a bad sale that was. I think I got it in around $20 and it's over 100 now. But I guess you never know. It's always kind of after the fact, it's so obvious. But when you're living it, it's hard to do. Let's see. Anything else went up today? VeriSign, 26 billion market cap company. Hey Kevin. Thanks, Blade. I just hold long term, so it looks better than it is. I mean, it was higher at one point, but if I did like most people, I just buy and sell, buy and sell. You got to give it time to breathe, time to grow. I'll show you my other one, my other portfolio. I mean, I don't care about showing. I know a lot of people don't like to show their portfolio, but I think the people who don't show it don't really make much money or don't have much money. It's kind of like when you know those courses you buy. The people who are selling those courses, I'm not talking about finance courses, any type of course. The only people making money are the people selling the course, not the people receiving the information. Here's my other portfolio. Netflix is almost in the lead. It's up 184%. Apple was up like 240% at one point, but it's kind of come down a lot. Pfizer is a laggard in this, and I put a lot of money into Microsoft recently, the past year, and it's down 6%. Amazon's down. I mean, I'm up overall because I got in at 124, but it was doing much better a month or two ago. Costco, Netflix, and of course Apple. I wish I put more to Apple, but I'm glad I put a lot into Costco and Netflix. Damn, Costco. I put 50,000 at the Costco, and it's already up to 136K. So really happy about that. I mean, you don't have to be a genius. You just have to pick good stocks and hold. That's the problem. That's the hard part, holding it. Anybody can pick a stock. It's the holding the stock that's hard. Bum Spanka, thank you. So generous. I really appreciate it. To Clean Spark, CLSK. And if you donate, it doesn't have to be a lot. It could be even $5. I'm happy to review, and I might even review it if you don't donate. But just throw it out there, throw out stocks, and we could take a closer look at them. Yeah, Clean Spark, a Bitcoin miner. That sounds right. $9, 2.5. Let's of course no dividend. Let's look at I think Simply Wall Street's better. It gives you a little more information. Obviously, the price moves with Bitcoin. That's a given. That's the main driver. So it's up 20% in the past week, down 53% in the past year. So it's not entirely correlated with Bitcoin, but it's pretty correlated. It is a company that has profits and losses. So obviously, it's not going to perform exactly like Bitcoin. But it's like a gold miner. They move with gold mining stocks. So they're positive free cash flow. The projection is 365 million by 2027. So let's grow it. Let's grow it at those levels. I think the WACC should be a little higher. It seems like a good value still. It's not profitable because they have the fastest Bitcoin mining hash rate. They have huge capex as they're investing in new mining machines. Exactly, it's about time in the market. It's so true, because you could try to spend all the time in the world trying to time it right, and it might work, but it might not work. So that's why put your money in and just forget about it. Simply Wall Street's at $22. Let's see what the analysts are at. Analysts are at 19. I try to be more conservative, so I'm at it is hard because when you see when things you hear news stories, or even a friend, even someone who knows nothing about the market, it does make an impression with you, and it kind of sits in your head, and then you start rethinking about it. But I mean, you could make anything. Like if you're a good lawyer, you could make a case for anything sounding good. Same thing, you could make a case for anything sounding bad. You give me a stock, and I could put together a 1-hour video on why it's such an amazing investment. That same stock, I could put together an hour video why it's such a poor investment, and I bet you I would give really compelling arguments on both sides. I like Wikipedia. It makes things kind of really clear and user friendly. Because if you look at a good stock, it really doesn't matter when you got in. 'Cause you can't even tell it when you look at the past. It's like a low flat line. Like you can't even tell the ups and downs. So at some point, if you're in a stock long enough, I'm talking about, holding it to your 50, 60, 70, why not? And you're sitting in a stock for 20, 30, 40 years, the past is just all a blip. But if you're only in stocks for a few months, yes, of course you're looking at the ups and downs. And let's see what they say about CleanSpark. Well, let's look at where it's trading. I like to look at it where stock has been trading. Not that it makes any difference, because the past doesn't predict the future. Just because a stock was $100 in the past has no bearing that it will hit 100 again in the future. But if a stock, like in this case, it broke through 50, right? And if you're looking at a similar company that never broke through 20, it just gives you more comfort that it can get to 50 again. It's kind of like muscle memory. If you did something once, it's a lot easier to do it again. Like if you need to bench 200 pounds and you've never benched even 150, it's going to take a while to hit 200. But if you benched 200 in high school and now you're in your 40s, Himax, that's a good one. Himax. Nice semiconductor company. Yeah, he Bonus Bank has the best stocks. 708. I do like Himax. But I look at so many companies, right? And if something blows up, you say like Nvidia, you're like, oh, I remember talking about buying Nvidia and I didn't buy it. I'm so stupid. But I bet you talked about buying like 50 companies. You just now you think of Nvidia because they blew up, but most of those other companies you talked about buying, you would have lost most of your money. But you don't say that. You don't say, oh, thank God I didn't invest in that stock, because there's really no upside to that argument. You just forget about it. If you 1.2, they pay a dividend, right? Yeah, 4% dividend. That's a pretty good dividend. When a dividend is 4%, it's the stock has probably come down quite a bit. Although it's up 40% in the past year, 9% in the past week. So that's kind of surprising. But you can see, yeah, it was 13 in the beginning of the year. So it's likely they were paying a 2% dividend, say in January, and they kept their dividend flat, but stock has come down. So when stock goes down, yield goes up. Let's look at the future. Okay, so the future isn't so great. They peaked at 390 million in 2022. Recently, they're only 124 million. So why is the projection so low? Let's just keep it at 120 million. Let's just see what it is. Even if we keep it where it is, I think the dividend's too high. To be conservative, I would say it's pretty close to where it belongs on a conservative basis. Now, that's assuming they're around 100 million of free cash flow. But if they get back up to where they were, they can easily be a $30, $40 stock. Yeah, it was a really good week. Makes you feel good, but it's all up and down. It's not like you have to, we were down like 10%, say, in the past 3-4 weeks. Maybe you lost 10% of your portfolio. Now it came up like 6-7%. So you're still down the past month or so. But if you just focus on this week, it's like, oh, look how much money I made this week. But I'm still trying to get back to my peaks. I'm still down from my highest level. That's what you want. You want to keep growing. You want to beat your all-time records. It's going to happen. Don't listen to people. I remember somebody showed the Great Depression chart. Somebody showed like how the Great Depression took about 20 years to recover. Like the peak right before the Great Depression, to get back to that peak, it was like 25 years. So there was a chart assuming we hit another Great Depression, and it would take like 25 years from now to get back up to where it was in 2025. And you're like, so how old will you be in 25 years? It's just all scare tactics. See, you can't even tell. Like, it's all just a straight line. This is a hard. Oh, this is not even what I want. This just goes back to. Okay, this could kind of work. No. So this goes back to 1915. Okay, so 1915. That's right here in the beginning. Okay, let's see the peak. The peak is right before the Great Depression. So 1929, it was 7,000. This is the Dow. So the peak right before the Great Recession is $7,000. That's when everybody's putting money into the market and using leverage. Then it came down like 80, maybe even 90%. What did it? This is hard to read this chart. I guess that's 1,000. It's hard to tell. So it went from 7,000. So it went down 86% from top to bottom, the entire market. It's a big pullback. And it by 1932, it bottomed out 1,000, and there was a lot of buying. It brought it back up to 4,000, but it's still trailing its pre-depression highs. It took until 1958. So 29 years. So imagine having to wait 29 years. It's a long wait. We can't even wait like a month. After like a month, people like sell. You had to wait nearly 3 decades just to get back. But then there was another pullback in the mid 60s. Like it got up to 10,000. So by 1988, it was still, in 1990, it was still 7,000. Granted, it did break through 7,000, almost 10,000, but then it came back down to 7,000. So if you bought it in 1929, when you were born, you invested in the stock market, you would have had to wait 72 years to get your money back, just to flatten out the market. That's crazy, right? 72 years. That's if you invest in the entire market. Most invest in the entire market, they buy individual stocks. So if you bought an individual stock, you could have made a ton of money if the company's still around. But that's why when you look at it, like 90% of investors lose money. But it's those 10% that make money, they make a lot of money. You know, maybe 90% is like, you know, like 10 million people, and they all averaged $20,000 each. They lost an average $20,000 each. But then you have the 10% of the market, which is like 1 million people, and they average a gain of $100,000, something like that. It's getting late here in Amsterdam. I'm going to sleep. Yeah, have a good night. Yeah, thanks a lot. Yeah, I'm always excited about Meta earnings. But this just makes you think. The reason it's different now than it was is because we weren't in. Now it's not only is the U.S. really strong now, which it is, but the world is strong. There's so many countries that have, even since the 1970s, let alone the early 1900s, so many countries are much stronger economically. That helps us, because when your neighbor is wealthier, then they have money to invest, to buy U.S. stocks or to lend to us. So it's just a different time. Whenever people think this is and they've been saying it ever since the Great Recession in 2008. So what is that? 17 years? That's all I heard. Like when the market went up from the Great Recession, that's all I heard. Oh my God, the Dow was $20,000. It's never been that high before. It's going to go down. It's going to be a market crash. It's going to be the worst crash ever. Then it hit 30,000, 40,000, 50,000. And that's all they say. It's always the same thing. This is going to be worse than. Why would everybody just suddenly become poor? It doesn't make sense. There's reasons why there was a Great Depression. There's reasons why there's dot-com crash. There's a reason why there was a Great Recession, subprime market crash. But there's no reason why should it just crash now? The companies are extremely profitable. Like the top 10 companies were always extremely profitable in the past, but now it's just unreal how much money they're making, because so many other companies beneath them are also really profitable. But if you ask these these bearish people, they just say, you'll see it's going to be. But if you ask why do you really think it's going to go? They're going to go, well, you'll just see. The market can't get this high. It shouldn't get this high. That's their answer. But there was mathematical proof why, like, there's Great Recession. People were flooding money into the market, and it was kind of like a rigged market back then. It was just, there was only a handful of people that kind of controlled it, it was a different time. And just things were getting purchased and bought that weren't really profitable. People don't have as much visibility back then as they do now. Now you can't have a Ponzi. You could have a Ponzi scheme, but it's so much harder now. Like when someone does it, it's amazing. When someone scams the market, it's a news story. It's a big deal. It does happen, but it's so much harder to do that now. Yeah, people who say we were going to lose reserve currency, is it multiples appreciation a factor for why the market has gone up so much? If you go back a long time, a 7 to 12 PE was average. No, that's a good point. That's how you should look at it. You can't just, it's just so stupid to say, a company shouldn't be worth $1 trillion. Just saying it. Oh, it should never be worth $1 trillion. It just doesn't make sense. Or the stock, the Dow should never hit 40,000. It just can't. It's too high. It's kind of like saying somebody can't run a 4-minute mile. It's impossible. It's just physically impossible. You can't run a 4-minute mile until someone did run a 4-minute mile. So you just can't. You have to have some proof. But that's a good way to look at it. Look at the PE ratio. PE. And that's how you gauge. Like if you want to say, are you more successful than your father? Like financially, you can look at how much money you made, how much money he made, adjusted for inflation, or if you look at your net worth, stuff like that. But you have to have something to back it up. But it's more expensive. It's more overbought than it was. That is true. But it's not like it was in the Great Recession. Look at the average PE was 120 and at the worst point. Like that's obviously an inflated market. Companies are not worth, you can't trade at 120 times earnings. So that was due for a correction because that can't happen. So if you look at the market on a multiple basis, is it overvalued? Just on the PE, a little bit. But right now we're trading at 28 times earnings. So that's our PE right now. Is it a little inflated, overbought? A little bit. But if you put a line through it, it's not that much higher. Like I said, you can't compare it to the 1920s and 30s. That's just how the market was. It was a different market. We controlled the stock market. It's a different environment. So generally, the stocks on average traded below 20 PE from let me look at this chart because I can see so from 1929 to the 90s, or even probably the 80s, from 1920 to 1980, most stocks traded below 20 PE. It kind of changed. Now, since 1990, I would say the average PE is probably around 25 to 30. And that's just how it's been the past 30 years. You can't get this high. You could still look for deals here and there. Once it gets to like north of 30, there's going to be a correction, which there was. It brought it down to 17, and 17 was a really good value. So that's why there's going to be a lot of buying when the market goes down. Because how does the PE go down so much? Well, either two things, right? The market goes down or earnings go up. And the only way it could go down so fast is a market crash. Then the Great Recession, and we had to kind of flood out. We had to get rid of the garbage. And then it got to a really low value. But ever since the past decade, from 2015 on, it's been sitting between 20 and 40, probably averaging 25, 26. So I think it's at a good point. I wouldn't say it's undervalued the market based on a 29 PE or 27 PE, but I would say it's close. It's appropriate. I could see a little pullback, but it's not going to come back down to below 20 because it really hasn't sat below 20 consistently. It did from 2009 to 2014 because there was a lot of fear. It was the second worst market crash ever, the Great Recession. But once participants got back into the market, it kind of pretty much the past decade, it's been trading above a 20 PE. But this is the market. You could still look for deals within this. And how could the whole market trade at a 6 PE? If something was a 6 PE now, people flood into that stock. It's like giving the company away because there was just no faith, right? A little bit. It was about a decade or so past the end of the Great Recession, the Great Depression. So there's still a lot of fear and concern, and there's just not much transparency. There's just so much transparency now. So if you want to look at it from an intelligent point of view, you would say, look at the PE ratio. You can't just say a company should never be a $1 trillion market cap company. Why? And they shouldn't be. That doesn't make sense. Because what if my revenue is 100 billion? Yeah, maybe a $1 trillion market cap is a bit rich. But what if my revenue goes from 100 billion to 200 billion? Then can my market cap be trillion? What if my revenue goes from that happened? These are trillions, by the way. I mean billions. What if my revenue is almost $1 trillion? Then can my market cap be $1 trillion? Of course. No one's had a revenue of $1 trillion, but there's companies now. What is it, like 700 billion for Walmart? And Meta is probably 300 billion. I think Walmart has the most revenue of any company. Yeah, they have the most revenue, the most employees, so they're about 700 billion. And they're worth 700 billion, so they trade at 1 times revenue. A retailer, it doesn't have as good margins, but let's see, most revenue companies. So you have Walmart number 1, but they're a retailer, so obviously their market cap isn't going to be $1 trillion until they get $1 trillion of revenue. But a company like Amazon, 600 billion of revenue. There's no market cap here, but they're what, 2 trillion? So of course a company can be $1 trillion market cap. It's like when someone says the Dow can't hit 50,000, it just doesn't make sense. Or Bitcoin can't hit 100,000. I mean, just have some logical sense behind it. Don't just say that. Right? There are winners in every market. Always look at cash flow. Ziff Davis, ZD. Let's look at Simply Wall Street. I'm starting to hate Yahoo Finance. I don't like the website anymore. It's down 40% in the past year. It's a digital media and entertainment internet company. They're almost 100 years old. The company owns technology and health-oriented websites. So what are their big websites? Yeah, so in 2021, it peaked at 140, which is lots of companies peaked at one in 2021, if you notice, after the .com rush. It's down a lot. Wow, 141.31. It's down 78% from the peak. So why is it down so much? Simply Wall Street's at 120 a share. Analysts are at 52. So revenue is up. I mean, it did peak in 2020, and it hasn't really. It did come down during COVID, but it came right back up. But it hasn't really grown in 5 years. Their revenue. So when revenue is flat, because if you think about it, their revenue, say, was identical since 2020, same revenue. It did come down, but just assume it's the same exact revenue since 2020. Here's the stock price since 2020. It's not flat, right? It got up to 140, and now it's down to 30. Same exact revenue. Identical revenue. So how could if the revenue was what was 140 billion? $1.4 billion. So 1.4 billion. So the revenue was 1.4 billion, and it was $104 a share. It's still 1.4 billion, and now it's $30 a share. How could that be? It's because in 2021 it was 140 because people thought. I mean, it was 1.4 billion revenue because investors thought it would grow a lot. It would be 2 billion in 3-4 years of revenue, but instead it's flat. And when revenue flatlines, people generally think it's going to go down at some point. It's just a matter of time. I bet you their margins got crushed. So you can see revenue is pretty much flat. 2022 to 2027, it's projected to be pretty much flat. Yeah, you see, and their earnings went down. They had 400 million of earnings in 2021, and then it's down like 80%. So just because revenue is flat, their expenses have gone up so much, it kind of wiped out all the profits. But the projection is for their profit to go up to 200 million. So it could be a good Pfizer is a good, yeah. Pfizer seems like a good candidate for like a 3, 4, 5x or 10x investment, right? Yeah, I don't know about this company though. It's they seem like they're kind of older. That they're not keeping up with the times. So they have television stations. Magazines. Yeah, they don't have like, it's kind of like that. What's that? Shit, what's, and I own it too, and I can't remember the name of it. Lumen. I got crushed on Lumen, down 66% on my Lumen. Stupid investment. Yeah, they have such old technology, Lumen. It's like kind of like they're just gonna fade out, fizzle out. Look how much they've come down. They were $50 a share, and they were paying a high dividend. They did get up to $10 a share because there was kind of like this resurgence of money putting into the stock because they were signing a lot of contracts. They signed contracts with all the big companies, like telecom contracts with like Google and Amazon. But last half, thank you. Oh, we'll look at Pfizer. I appreciate the donation. Yeah, Pfizer seems like a really good opportunity. It's their pipeline, right? Is their pipeline? Do they have enough drugs to fuel a like significant growth? So their free cash flow is projected to be 19 billion, which is a lot lower than the past, but right now they're really struggling. They're I think they do have a lot of capex spend. So look at the free cash flow has come down a lot. If they get back up to that level, 19 billion. Let's just say they get to 14 billion. Let's raise the whack a little. So for them to like 5 or 10x, anything's possible, but it's just, I mean, Nvidia did it. Nvidia went from 200 billion to like 3 trillion pretty quickly. But I don't know if Pfizer has that growth potential where it can just like, I mean, Nvidia was growing their revenue and cash flow like 4x a quarter. Like they were like doubling and tripling. So does Pfizer have that potential? Let's look at that dividend. So they're still raising their dividend. You can see this, the horizontal bars. They're not cutting their dividend. So the yield is really getting up there because it was a 3% yield and it was still around 3% up until 2023, and the stock has just come crashing down. So the yield is 7.5%. So either the stock goes up or the dividend gets cut. I mean, you can't really. It's hard to just pay a 7.5% dividend without people buying the stock. if it stays at these levels, people are going to totally buy the stock unless they cut their dividend, which they might, because the free cash flow has been on the lower side. So that's why the stock is down. So what did I say? 26? 23. So it's back, in 97, it was trading at 28 years ago. It was trading at 23. So, and they did peak in 2022 at 56. So the market is pricing in a dividend cut. The market is not pricing in for the stock to double. That's generally what this means if investors are willing to avoid the stock, even though they're paying a 7% yield. But we'll see. We'll see if they Pepsi. I think that will go up from months behind on Toyota expanding in the US. Toyota has the most debt of any company in the world. Debt. It's Toyota. Okay. I thought it was Toyota. Maybe it changed. Toyota's number 2. Volkswagen is number 1. Verizon, AT&T, Deutsche, Ford, Charter, Comcast. Do you see a trend? 2, 4, 6, 8. The top 10 companies are contained within 2 industries: autos and telecom. The next one's an energy company, and then an IT company, then an energy, then 2 more autos, energy, healthcare, beverage. Okay. It's expensive to grow and scale these 2 types of companies. Auto companies, because you have to build manufacturing facilities to make the cars. Very expensive. Lots of machines go into those factories. In telecom, you have to build, a lot of foundational work, laying wire, getting contracts with the city to build, to put cables in, or whatever hardware they have to build. Lots of infrastructure. So these kind of companies, although pretty safe companies, everybody needs cars and everybody uses their phone. It's just expensive way to make a profit. It eats into your margins. But that's why they all pay a dividend. They have to, because nobody will buy them if they didn't pay a dividend. In 2021, Toyota was number 1 most debt. Volkswagen, AT&T, GE. Wow, $278 billion of debt in 2014. GE. So that's a cheap way to finance your company. It's just it could really drag you down, debt, because you have to pay the interest payments on your debt. And so it could really make it hard to really be successful, because it's kind of like you want to use debt, but you want to use the right amount of debt, the right amount of equity, and there's a balance. Yeah, I don't like investing in car companies, but if you could have made a ton of money with Tesla. But that's not it's not normal. This is the only time a car company, and one of the few companies that grew at this level. I mean, it went up like what 100x in like. So you could have got it. This is split adjusted. So it looks like you could have got it for like $20 back in 2019. $20. So it 22x'd, 23x'd in 5 years. I mean, that doesn't happen. I mean, to 23x, it takes, if a company ever does it, it takes 30, 40, 50 years. Now companies are doing it. NVIDIA did it. Of course, technology companies can do it, but a car manufacturer can't really grow at that rate. But people think it's different with them. They're not a car manufacturer. They're a technology company because they make batteries. But that hasn't worked out for them. They're pretty much just a car manufacturer. And they've come down. Sales came down for the first time. They sold less cars. This is 2020. So I didn't even realize 2024 was worked in 2023. So they sold, like the growth, 75,000 cars they sold. 76,000 cars in 2016. And you could see the steady and strong growth, which it worked out because investors were buying Tesla at 100 times earnings, 200 times earnings, because they thought this would happen, and it did happen. But they're not that big. I mean, in 2023, they peaked at 1.8 million cars. Still not a lot of cars in the whole scheme of things. And it actually came down in 2024. So the red is the fourth quarter. I wonder what I wonder what it looks like for Toyota. I have to pay money. Como is a subsection base. I'm not sure what that means, but okay. So yeah, sounds good. So yeah, good stream. Let me know. I'll try to do a stream over the weekend. Yeah, thanks for joining. Thanks for the donations. And let's keep rocking. Let's hold. Let's just keep putting money to the market. Don't sell unless you need money. Okay, thanks a lot for joining. Talk to you later.